All right, so let's break this down. When people talk about tokenized deposits or bank-issued tokenized money, what they really mean is your normal bank deposits, but supercharged with a digital twist. Imagine taking the cash in your savings account and putting it on a blockchain, like your own personal digital ledger, but without losing all the protections your bank gives you. That means FDIC insurance, legal safeguards, all of that stuff stays intact. It's not some wild crypto experiment where your money floats in the ether. Nope. This is literally old school banking meeting futuristic tech. Banks aren't inventing new currency here. They're taking the money you already trust and wrapping it in a layer that works seamlessly on blockchain networks. It's like turning your grandma's safe into a high-tech vault that can instantly send money across the globe without any sketchy middlemen. And here's why it matters. This approach reimagines payments and value transfers. It could make sending money to another country or paying someone online feel as instant and reliable as texting a friend. For DeFi fans, it's a game changer. Your cash can now interact with digital platforms while keeping the trust of traditional banks. So basically, tokenized deposits bridge two worlds: the old, trusted banking system you grew up with and the high-speed, programmable world of crypto. It's a quiet revolution happening right under our noses, and honestly, it's kind of wild when you think about it. Now that we know what tokenized money actually is, you're probably wondering, why the heck are banks jumping on this trend in the first place? All right, so here's the real tea. Banks are absolutely loving this whole tokenized money thing, and it makes total sense why. Imagine having all the trust and safety of your regular bank account, the FDIC insurance, the regulatory rules, the peace of mind, but then also getting the speed and flexibility of crypto. That's exactly what tokenized deposits deliver. It's like your money suddenly got a turbo boost, but still stayed in the safe zone. Think about it this way. Normally, sending money internationally or doing some complex payment stuff can be a headache. You wait days, pay fees, and deal with tons of red tape. Tokenized money changes that. Now, banks can move deposits across borders instantly, automate payments, or even link them to smart contracts without losing the legal and regulatory backbone that makes people trust banks in the first place. And it's not just a tech flex. Regulators in the US, Europe, and Asia are starting to lay down clear rules for digital assets. Tokenized deposits fit perfectly into that framework, which means banks aren't flying blind. They can innovate without risking fines, lawsuits, or reputational damage. In short, it's like having the cake and eating it too. Modernize payments, reduce legal headaches, and open new revenue streams all in one move. But hold up, it's not all sunshine and rainbows. Here's the kicker. Tokenized money starts to compete with something that's been ruling the crypto scene: stablecoins.
Here's where things get really interesting. Both tokenized deposits and stablecoins are racing to become the digital version of money, but they play the game very differently. Think of stablecoins like a cool, fast scooter. They zip around quickly, can get you anywhere, and aren't tied to any official rules. They're usually run by non-bank companies and backed by off-chain reserves. Things like government treasuries or cash sitting somewhere in a vault. They're flexible, fast, and often super convenient for moving value online. But they're not risk-free. If the company behind them fails, your scooter to break down. Now, bank-issued tokens are more like a certified luxury car parked safely in a regulated garage. When you hold one, you're not just holding a token. You own an actual claim on a real, regulated bank deposit. The bank guarantees it. This instantly changes the rules of the game. Risk drops, trust shoots up, and liquidity is more stable, even if the ride isn't as flashy or fast as a stablecoin. This isn't just a subtle difference, it's a tug-of-war between two philosophies. On one side, you have decentralization, fast, flexible, and cutting edge. On the other, regulation, secure, credible, and backed by law. For anyone building in crypto, using stablecoins, or thinking about tokenized money, understanding this distinction is crucial. It affects how you move funds, manage risk, and even how the market views your choices. So next time you hear someone say digital money is the future, remember, not all digital money is created equal. One is speed and flexibility, the other is safety and credibility. And the winner isn't just about technology, it's about trust. With banks stepping into this space, the numbers start to tell a bigger story. Check this out. Institutional interest in tokenized cash is absolutely skyrocketing. Recent reports suggest that by 2030, stablecoins and tokenized instruments could hit a mind-blowing $3.6 trillion, with stablecoins alone capturing around $1.5 trillion. Yeah, that's not a typo. Trillion with a T. So what does that actually mean? Think of it like this. For years, traditional finance was kind of sitting on the sidelines, watching crypto from afar, sipping their coffee. But now, they're not just watching, they're diving in, integrating crypto into the mainstream financial system. Big banks, insurance firms, and other institutions are starting to see tokenized cash as a legitimate, efficient way to move and store money. For stablecoin issuers, this is where things get real. Until now, they were mostly competing with each other, USDC versus USDT, for example. But now, regulated bank-issued tokens are entering the arena. These aren't just any tokens. They're digital representations of actual bank deposits. That changes the game entirely. Risk, credibility, and trust, these factors suddenly swing in favor of banks, and stablecoin issuers feel the pressure. It's a classic showdown. Flexibility and speed versus regulation and safety. Stablecoins are still fast and programmable, but bank tokens come with the full weight of legal backing. The market is evolving fast, and anyone in crypto or finance needs to understand this shift. It's not just about technology anymore. It's about who people trust with their money. So whether you're an investor, a developer, or just someone curious about the future of money, keep your eyes peeled. The next decade is shaping up to be a battle over who controls digital cash, and the stakes are enormous. So what does this mean for stablecoins? Are they about to get eaten alive?
Here's the deal. Tokenized deposits are quietly becoming a serious game changer, and here's why. First up, safety and trust. When you hold a bank-issued token, you're not just holding some random digital asset. You're holding a real claim on a regulated bank deposit, backed by law and oversight. That makes them incredibly appealing, especially for institutions or even retail users who used to rely on stablecoins for stability. Think of it like swapping a rented apartment for a fully owned condo. Same space, but now you have legal protections that really matter. Next, we have liquidity migration. Money flows where it's safest and easiest to use. Funds that once fueled stablecoins might now start moving into bank-issued tokens. It's like watching traffic shift from a busy, unregulated street to a smooth, regulated highway. This could significantly change how capital moves in the crypto ecosystem. Then there's deposit retention. Banks are reclaiming the funding and customer relationships that stablecoins were indirectly tapping into. Instead of outsiders controlling a chunk of the liquidity, banks keep it in-house, strengthening their balance sheets and deepening trust with clients. Long story short, tokenized deposits aren't just a side thing or a niche experiment. They're a direct challenge to stablecoin dominance. The advantages are clear: regulation-backed trust, safer liquidity, and stronger relationships. Stablecoins still have speed and programmability, but tokenized deposits bring a level of credibility and security that's hard to ignore. For anyone watching crypto, DeFi, or digital finance, this is a key turning point. The market isn't just evolving, it's reshaping who controls digital money, and tokenized deposits are quietly staking their claim at the center of the action. But banks don't just have credibility on their side, they also have infrastructure that stablecoins can't easily match. Here's the flex. Tokenized deposits plug directly into the systems banks already use. Payment rails, compliance checks, reporting, you name it. Banks don't have to reinvent the wheel. They just add a blockchain layer on top. Think of it like upgrading your car with a turbocharger instead of buying a brand new vehicle. Same trusted engine, just way faster and more efficient. Now, stablecoins, they're still amazing, no doubt. They're fast, programmable, and flexible. But here's the catch. They need separate compliance systems, reserve management, and often navigate a maze of regulatory uncertainty. That's a lot of extra work, especially for institutions that care about risk management. Tokenized deposits solve this problem. They give you crypto speed with traditional reliability, meaning banks can move digital cash as fast as DeFi apps do, but without sacrificing safety or trust. For big players, think asset managers, corporations, and even governments, this is huge. They get the innovation of blockchain without the headache of building everything from scratch or worrying about whether regulators will swoop in. In simple terms, tokenized deposits are like offering crypto rails with trust baked in. You get the slick, modern convenience of digital finance, but it's all anchored in systems people already understand and rely on. That makes adoption smoother, faster, and less risky. For some stablecoins, this could be a wake-up call. They've dominated the digital money scene for years, but now bank tokens are offering a version of the same speed, with credibility and security baked into every transaction. The landscape is shifting, and anyone in crypto, finance, or digital payments needs to pay attention. Of course, the regulators are watching this closely, and their rules could completely reshape the battlefield.
Over the past couple of years, regulators have been stepping up their game. They're making it clear that not all digital money is created equal. Bank-backed tokenization is now viewed as less risky because it keeps all the traditional protections intact: insurance, anti-money laundering checks, AML, know your customer verification, KYC, and overall stability. In other words, it's digital money that plays by the same safety rules as your regular bank account. For stablecoins, this shift is a wake-up call. These non-bank digital assets still move fast and are programmable, but regulators are starting to scrutinize them more closely. Legal hurdles are popping up, compliance pressure is rising, and the window to prove their value is shrinking. Imagine running a race where suddenly the rules change halfway through. That's the world stablecoin issuers are facing. This isn't just about regulations, it's about market dynamics too. Regulators are subtly signaling to the market, if you want to survive and thrive, play by the rules or risk getting crowded out by safer bank-issued alternatives. Banks already have credibility, legal protections, and deep liquidity. By adding tokenization on top, they're creating products that are fast, digital, and institutionally trustworthy. Non-bank issuers now face a critical choice. They can either innovate under pressure, showing they bring unique value that banks can't match, or they could slowly get sidelined as institutions and regulators favor bank-backed solutions. For anyone tracking the future of money, this is a pivotal moment. The game is no longer just about speed or programmability. It's about trust, safety, and regulatory alignment. Bank-issued tokenized money isn't just another experiment, it's quickly becoming the standard, and the rules of the digital money race are changing fast. So what's the bigger picture here? How does this affect the future of money and DeFi? We're standing at a turning point in global finance. Imagine merging the old and the new, the trust and security of legacy banking, combined with the speed and transparency of blockchain technology. The result? Hybrid money that's both safe and efficient, the best of both worlds. For DeFi, this is a real challenge. For years, the narrative has been that decentralization always wins, that permissionless systems are inherently superior to banks. But now, banks are stepping into the digital money space with tokenized deposits. They could reclaim a huge chunk of value transfer and settlement that once flowed through DeFi platforms. It's like watching the big, established players return to a game they once abandoned, and they're bringing their credibility with them. This doesn't mean DeFi is dead, it just means the rules are changing. Projects can't rely on payments alone to stay relevant. They'll need to innovate beyond simple transfers. Think composability, building complex financial products by stacking smart contracts, cross-chain protocols, moving assets seamlessly between blockchains, or creative yield-generating products. DeFi's strength has always been flexibility, and now innovation will decide the winners. On a global scale, tokenized money has enormous potential. Cross-border payments could become cheaper and faster, settlements could happen in seconds instead of days, and financial services could reach millions who are currently underserved. It's a chance to increase financial inclusion while keeping the system safe and regulated. In short, we're entering an era where trust meets innovation. Hybrid money is reshaping how value moves, how banks operate, and how DeFi evolves. The landscape of global finance isn't just changing, it's being rewritten, and the next decade could look nothing like the last. And that brings us to the ultimate takeaway for anyone living in the crypto space today.
The rise of bank-issued tokenized money isn't a minor tweak. It's a tectonic shift. Stablecoins sparked the revolution, but banks are now absorbing that innovation into regulated rails. For anyone in crypto or DeFi, the smart move is to adapt to this hybrid world. Use bank-backed money for stability, keep stablecoins for speed and flexibility, and layer your strategies smartly. This isn't just about surviving, it's about winning in the next era of digital finance. If this video resonates with you, click the card above to watch more insightful videos. This is Blockchain Money.